Good morning and a very warm welcome to this special edition of Financial Fitness Fridays, the live talk show talking about money, trying to talk about financial education in a different way. Today, my name is Darren Laverty. Today I have our personal finance guru, expert, Jamie Smith. He's been very popular. He's been on these sessions before. Anybody would like to see the previous sessions that we've done, there's a YouTube channel, Financial Fitness Fridays, and they're pretty much all on there. So have a browse around on that one. So today the session's going to run for half an hour officially, and I'm going to be watching the clock. And then at the half an hour stage, you can go, but we will stick around for questions. So there will be an opportunity there. So as we go through, if you'd be so kind, if you've got questions, pop them into the Q&A. If during the session with Jamie, those questions, I can see them and they're relevant for that moment, I'll bring them up. If not, we'll save them till the end, and we'll try to get through as many of those questions as we can. If we can't can't answer some of those questions, we'll try to pick some of those up individually. If they're a bit personal, then we'll just email you and do that, more privately for you. Not a problem. So today is the cost of living crisis special edition. I mean, it's all over the news at the moment. And I have to say, I've been doing this job now for 32, 33 years, and I've never seen it so bad when it comes to this. I've never seen such a lot of change go on in one go, and we do have this kind of perfect storm. And, I've been talking about this for many years. I've been talking to employees and employers, and I've been talking about being prepared for these things, getting on the front foot, making sure that we're financially resilient. So we've got a good sense of financial well-being. So we've got plenty of cash in the bank. We've got plans. We've got no debt. And I know that's the ideal world, but if we'd have been striving for that, I think we arrive at these problems much better prepared. And so, we then had the pandemic for a couple of years, and now we've got the cost of living crisis. And it is a worry. I mean, I've certainly been looking at my own expenses, and we'll touch on some of that as we go through with Jamie. But we've got this perfect storm of five things. We've got the energy hike prices going up, energy in terms of gas and electric. We've got interest rates, they're under threat, they're creeping up. We've got fuel in our cars, petrol and diesel going up. Just this month, we've seen the introduction of the new national insurance level. It's at 15.05% for employers, and it's got up 1.25% for employees. And then on top of that, inflation, and what's the impact of inflation? It's kind of one of those invisible things. So again, we're going to really pick Jamie's brains today and try to understand all this stuff. And I think for a lot of us, we're running out of ideas, running out of tools. And so one of the key things we want to try to do is to kind of prepare people for this better, to make them more financially resilient. We don't want to be getting stressed. And one of the reasons we get stressed is when we get out of control of our money. And so to feel a sense of control, to avoid the stress, what we really need to do is we need to increase our knowledge, which is we're going to do some of that today, and also it's the strategy, the actions we're taking. So hopefully we can influence some of those today and get you more involved with this stuff, and so hopefully help you through weather the storm. Get on the right side of it. That's the key thing. I think ideally prevention is better than cure. But we are where we are, so let's tackle it head on. So Jamie, can I ask you to introduce yourself and appear so we can
Yeah, good morning, Darren. Good morning, everyone. Can you hear me?
Brilliant. Yeah, thanks for coming on, mate. Appreciate it. I've got a question already.
My pleasure. Yeah, thanks for having me back on.
Someone's asked a question about pensions already, so we'll talk about that. Absolutely, good question. Right, Jamie, thanks for jumping on. Appreciate it very much. I know you've done a bit of background work on this for us already, but we've got quite a lot to get through. So straight into the big one, the cost of rising cost of energy. It's trying to understand what's going on here, but also then the impact. And then is there any practical ideas that you can suggest to people, working with your clients, for example?
Yeah, so I've been looking, doing a bit of background around this. And the reason why is because energy is just such a big part of our household expenditure. It's probably one of the top 3 bills for most people. And I have to say, it's something that I find incredibly complex, in fact, too complex. I've been a financial advisor for over 15 years, and I found it pretty difficult to get my head around how the energy cap works, how generally the providers charge for energy. And I must say, there is some excellent stuff already out there. The one and only Martin Lewis has covered this really well. He's got some excellent YouTube videos out on it. So I'm not going to try and attempt to be a cut price version, but I think today is all about helping people to engage more about their finances. Normally we talk to people about focusing on the longer term and creating a plan to meet those longer term objectives, but you can't do that successfully unless you've got your shorter term finances in order, and that means looking at your budgeting. So starting with energy then, just to give you a bit of background as to what's going on at the moment, we all know that energy prices are increasing pretty substantially. In fact, I was quite shocked when I looked at the actual figures. And the primary reason for this increase is down to what's known as the energy cap. And the energy cap is effectively the cap per unit of gas and electricity that each provider can charge. Now that is significantly increasing. I think we've got a table, Darren, where we can just show people the differences between what the prices were and what the new prices are since the start of April. There we go.
You see that? Yep.
So we can see there for electricity a 33% increase, and gas a 75% increase there. So, you know, we are talking about significant increases. We've also got an increase to something called the standing charge. So I assume that's just for providing the sort of infrastructure, if you like, the maintenance of all the services and pipe work, that kind of thing. And you can see that overall, a typical household can expect their energy bill to increase by a whopping 52%. Now, a typical household energy bill was around £1,200. Now we're looking at something in the region of £2,000. So we're talking about around about 600 to £700 more a month, about £60 a month, something like that. Now, I've been looking at my own bills because I wanted just to see, because I've been sent a projection or an estimate, if you like, of how much my bills are going to increase. And it's far more than that. It's about four times the amount, in fact. And that's simply because my consumption, my usage, particularly of gas, is much higher than the typical household. So a typical household consumes about 12,000 kilowatts of gas. Mine is around double that, and it's got me thinking, because I don't live in a stately home. We're pretty liberal with the consumption. I mean, the first thing I did was go around turning off all the radiators, but it's still pretty significant, and that is largely to do with the efficiency of the home you live in. So if you live in an older home, then it might be a bit leaky when it comes to your energy. So a few years back, there were lots of government sort of backed programs, incentives to help people insulate their homes more. That has actually disappeared. They sort of fell out of fashion. So there's more pressure on government to help people around that. Now, just some more bad news, if you like. I'd hate to be the bearer of bad news, but the message is that this is going to get worse in the short term, unfortunately. So the energy cap is reviewed every 6 months, and it's next going to change in October. And at this point, again, it depends on lots of external factors, but at this point, the energy cap is forecast to rise by another 25%. So if the average bill is £2,000 a year at the moment, we're going to be looking at an increase to £2,500 in October. So I think the most important thing is, again, as you mentioned, it's all about being on the front foot, about looking forward. I'd encourage people to start thinking about how they're going to absorb even higher prices in months to come.
Okay, so this is all quite scary bad news. I think we're kind of aware that it's there, it's coming. What have you got some practical steps that people could do right now to try to get on top of it, get on the right side of it, manage it, whatever? I mean, I know there's no magic wands we can wave, but what would you suggest?
Yeah. Yeah. I mean, I sort of short of telling my wife to run up and down the stairs to get warm after I turned off all the heating. There are a couple of things I can suggest. Firstly, a smart meter. I know many people have them, but also many people don't. And smart meters have got some bad press, some bad PR surrounding them. I don't really understand the reasons behind it. I've done a bit of research. I think people are concerned about the accuracy, if you like, and just the thought that their consumption is being sort of monitored, if you like. But there's no evidence of any systemic flaws to smart meters. And what smart meters do is to help you to understand your consumption more. You can engage with it. They will help you to understand, for example, how much energy it costs to boil the kettle. And much to my surprise, I can tell you it's about 15 to 20p. So, you know, depending on how many cups of tea you drink a day, that can add up quite a bit over a month. And I would encourage anybody who hasn't got a smart meter at the moment to contact their provider and look at getting one installed, because it will help you to understand your consumption a lot more, and you can work out what are the more costly appliances in the house, that sort of thing. The
also,
second thing,
Jamie, just on that, smart meters don't cost anything to have installed, do they?
They don't. No, they don't actually. They are. They do it for free. So yeah, it's comes at no cost for people. It's something you can do pretty quickly as well.
Okay.
The second thing I'd suggest, which does come at a cost, is getting a smart thermostat. And a smart thermostat basically allows you to control your electrical appliances and also your heating and your hot water from your smartphone. So, for example, when you're away, you can turn down the heating and obviously use less as a result of it. And then just before you come up, you can perhaps put the heating on for an hour or so before you arrive back home. It just helps you to control your usage a little bit more. And I found I've had one in the past. I intend to get another one. I moved house last year, haven't got one installed yet, but we found it made a significant difference to our energy bills. And you can get them installed for around about £200, perhaps even perhaps a little bit more, depends which version you go for. But there's lots of different providers out there, and I certainly encourage people to look at getting one of those.
Yeah, I actually, when we prepared for this last week, I actually went online and I bought myself a few bits. I've got a hub and a thermostat, etc. And it made it look like it was very easy to install. And I've got the stuff, and I've got absolutely no idea. So I'm going to have to get somebody in, I'm afraid. But it'd be nice to see what's going on.
Yeah, I do think you'd need a qualified engineer to install them. That's certainly part of the cost. You know, look, there's lots of tips out there about how to insulate your home better, how to cut down on energy consumption. I'm not going to go into those because there's lots of other people who are far more knowledgeable than me around it. A couple of other things just to be aware of. If you are paying for your energy by sort of cash or credit, that comes at an increased cost as well. If you switch to direct debit, you could save about £47 a year just by doing that. But also, I just want people to be aware that if they are struggling with the energy bills, the best thing you can do is don't bury your head in the sand. Speak to your energy provider. They are pretty sympathetic, as you can imagine, about this at the moment. They will speak to you about setting up some sort of revised payment plan where you'll spread the increased cost over a longer period of time. But as you said, be on the front foot. Don't sort of think the problem's going to go away, because it isn't. I'm afraid we're going to be facing higher prices for some while yet. But yeah, it's really important that you speak to your provider if you are facing difficulties.
Brilliant. Okay, look, so I'm conscious of time. There's loads of questions coming in already, so you can imagine, probably have to park them. There's actually quite a few questions coming in on pensions today, which is quite interesting. We'll see what we can do later on. Might have to take them offline. So the other concern is this kind of invisible enemy, the inflation. I mean, inflation's been lots of figures being touted. The impact on savings. Just tell us what you think about inflation, where it's going, what the impact is, Jamie.
So yeah, inflation is the rise in the cost of living, the cost of the goods and services that we buy and we've seen certainly inflation sort of leap up, started to surge over the last 12 to 18 months or so. Now, inflation, I think the best way to think of inflation is almost like a tax. And because inflation's been creeping up, what does a tax do? Well, it steals money out of our pockets, and as a result, we're worse off. We have less money to spend. Inflation in the UK is actually measured based on a basket, a shopping trolley, if you like. There's about 650 different items placed in that shopping trolley. That's how the government tends to measure inflation in the UK. It's said that the current sort of official rate of inflation, if you like, is around about 6%. Well, I think the real inflation rate, when you start to look at, your grocery shopping, the things that we all buy in practice, is probably about 10 to 15%. Now, I was speaking to my father-in-law about this because I was saying, this is terrible, and he can remember back in the 70s, and in one year, in 1975, the inflation was about 25%. So, it's not quite as bad as that. And the general consensus is that although inflation is high at the moment, it will start to fall back over the next couple of years. So let's hope it's not going to be persistent.
I actually remember that, Jamie. I actually remember my mum. I mean, I was only about 10 then, but my mum was complaining that every week the cost of shopping went up. She was watching the price of a loaf of bread. It just crept up every single week at that time. Crazy. So what can people do about it? Anything they can do immediately now?
Well, I think just in terms of your cash savings, your investments, it's important to be mindful that inflation does erode the value of cash first and foremost. So if you've got lots of surplus cash, it's just sitting in a bank account, perhaps earning 1% in terms of interest, it's going to be eroded pretty quickly by inflation. So if you don't need that money, if you've got a sort of a 5-year investment horizon, if you like, then think about investing it. Think about investing it where you're going to get a better return than you would do than your current savings. That's really, really important. And the other thing is to look at, if you have got investments or pensions, have a look at your portfolio, have a look at how it's been performing over the last 12 months. Perhaps speak to an advisor. Is it invested correctly? Have you got the right balance in there? Is there any investment changes you can make to protect your savings against inflation in a slightly better way?
Yeah, I was watching something on the television yesterday. I think on savings there's a double whammy because we've got inflation, which is eroding it. And I think one of the concepts is to imagine that your money is like a big block of ice. And it's every time you look at it, it looks the same, but it's actually slowly melting away, and that's inflation affecting it. But the other thing that they've talked about, we're seeing record rates of people spending their savings because of the cost of living crisis. We've got a double whammy. The actual value is going down because of inflation, and people are having to dip into that. So we're seeing outflows at record rates at the moment. Just conscious again of time. I want to promise to keep to the promise of half an hour if we can. So thanks for that. Interest rates. Just talk to us about that, Jamie. Will they go up again, in your opinion? And if so, what can we do and why?
Yeah, absolutely. So the direction of travel, if you like, for interest rates is upwards. There's no doubt about that. Interest rates have already risen from the record low of 0.1%. They're currently at 0.75%. A little bit of research. The consensus, if you like, is for interest rates to rise again and be around about 1.25% by the end of the year. And in fact, they are forecast to be as high as 3% possibly at the end of next year. Now, as I said, those are just forecasts or estimates only, and they are largely determined by external factors, impact on inflation, all that kind of thing. The main thing that people need to be aware of with rising interest rates is if they have a mortgage or any other loan or credit card or anything like that, then the cost of those of having that debt is also likely to rise. So again, looking at my own mortgage, I'm currently in a fixed rate period, but that ends in December. So I've been looking at, what would happen? What are my monthly payments going to be in December, assuming that interest rates are about 1.25%? And there's lots of calculators online. If you just Google interest rate mortgage calculators, if you like. You can have a look. You put in details about your mortgage, your current outstanding balance, your term. You look at what the rate would be in December. So you could add. I've added 1% to my current rate because that's going to be the increase since I started it, and it's given me a sense of what I can expect to pay, or how much more I can expect to pay my monthly payments. And again, that just helps with budgeting. I'm looking forward, thinking about, okay, well, they're going to increase as well. Where am I going to find the money? What are we going to have to cut back on in order to meet that higher cost?
Yeah, I think it's. I mean, I'm on a fixed rate for 4 more years, so I can relax, and I think that's important. I mean, I think we're always trying to find the best rate, but I think it's about control. It's, you know, we want to make sure we have as much control as possible. We can't control energy prices, we can't control fuel prices, we can't control inflation. We can control mortgage rate, i.e. by fixing it, and that way we can budget much easier. So more control, less stress, very simply. So always a good idea to be looking at that. Is it even worth looking at if they stop to fixed rate early and there has a penalty, sort of doing some maths and finding out whether it's better to go into a newer fixed rate for a longer term? Is that plausible?
Yeah, I think it's worth considering. Obviously, it can be complex to look at, you know, the cost of that early repayment penalty, and then looking at how much you would potentially save by fixing in now. So, you know, that's based on lots of different assumptions. I think it will depend on what your individual repayment penalty is going to do. Largely, I mean, I have seen a bit of research on this as well. It's thought that the best thing is to, you know, generally not break that early repayment penalty, but every mortgage is going to be slightly different terms. But yeah, certainly something to look at.
Make sure you get advice on it, professional advice on that. I'm going to jump the question because I think I want to talk about national insurance because that's very current. I think if we get time, we could talk about fuel, petrol and diesel, but just national insurance rates have gone up. I know that the threshold has gone up a little bit as well to pull some people out of that. But how will people be affected? Some examples of that, Jamie, and is there anything they can do?
Yeah, so as you mentioned, we're all going to be paying slightly more tax, 1.25% increase. So again, about thinking about how that's going to impact on your personal budget. The government's come under a lot of criticism because you know, they could have deferred that tax rise at a time when prices are going up. The government's facing a little bit of a dilemma at the moment because the reason why prices have been going up is because of demand, massive demand, and what they're trying to do is control demand, reduce demand, and that's why I believe that they've still sort of applying the tax rise. But yeah, it is going to have an impact. It's going to mean less pay, less take-home pay. And again, I would encourage people just to have a look at the salary calculators online to see how much it will impact them.
Okay, so you mentioned things online a few times. I'm just going to share with everybody a document that everyone's going to be sent after this session. It might be useful. Hang on, where are we? Oh, I'm going mad. Right, can you see that? Useful document, it says. Can you see that? Just
about. I can't read it. It's
okay. Well, so what we're going to do, we're going to email that to everybody on the session today, and on there's some useful resources and some of the things that Jamie's been mentioning, some new ideas on there, and it's probably worth, you know, thinking about what Jamie's suggesting. Is one of the ways to tackle this is to get on the front foot, engage with it, know what's going on, get in control of it. Rather than up to now, we've kind of just let these things happen to us. You know, now's the time to do that. And I think we all know it's important to take control, do some budgeting and that sort of thing. But we've never really had a good enough reason why until now. You know, now's kind of pushed us over the line a little bit, I think. So there's lots of really useful stuff on it. So I'm going to get that. We'll make sure everybody gets a copy of that. So just on, so I think we've talked about that. The other thing that we do have is I'm going to paste it in. We have a tool. It's called the Financial Wellbeing Assessment Tool, and it's a feelings-based questionnaire which you can do online. And what it will do, it will give you a score of your financial well-being. You don't have to go and dig out any information. You can just answer it off the top of your head. And what it will also produce for you is a recommended action plan. So what I'm going to do, I'm going to just paste into the chat function the link to that. If anybody wanted to grab it, feel free to. There we go. Feel free to have a go of that. And what you'll get is you'll get a financial wellbeing report. I'm going to show you an example of one. I mocked one up a couple of years ago. So this is a questionnaire, these sort of questions, and then you'll get a score, and it will also show you about benchmarking. So you can see sometimes it's just nice to know you're not alone. You know, I'm feeling a bit stressed about money, but how do I compare to other people? So that's kind of useful. So you'll get your score. Okay, so I mocked this one up. So I made it extremely stressed. It's a 2, it's a low, it's just marks out of 10. The average score is 6.2. So you can see where you fit into that. But the other thing that's quite nice is there's the benchmarking, is you get a recommended action plan based on your demographic and your level of stress. So it's a bit of a blunt instrument, to be fair. But again, there's some resources on here. And I can promise you something, if you want to do this and you have to put your email address in, we will definitely not be contacting you. This is not a marketing exercise. We're just giving this away to you to try it out. It might help, because again, in 6 months' time, when we're further down the line into the cost of living crisis, you might want to run this again just to get a sense check. Is your financial well-being getting worse or not, or is it getting better? It'd be nice to know. So that's what that's about. So if you do that, oops, have I on my back? Okay, yeah, so if you want to try that out and then park it for 6 months and have another go, brilliant. And it'll just bring financial well-being and taking control kind of to the forefront of your mind, and hopefully kind of it'll dovetail with what Jamie's been talking about in terms of getting on the front foot and engaging with all of this stuff and taking control of that. So I think, how are we doing for time? We've got a couple of minutes before the, so just on the last 2 minutes in, Jamie, before we go to Q&A, we didn't talk about, very much. We didn't talk about petrol and diesel. Just do you want to quickly spend a minute on that one?
Yeah, well, I think there's not a lot to say. Obviously, every time you drive past a petrol station at the moment, you can't help but see the prices are rising pretty significantly again. The same as gas. I've been again doing a little bit of research. The average price of petrol now is 165. And diesel 179. So the government did in the budget announce a 5p cut per litre on the dual levy, on the petrol levy. But you know, a fat lot of good that's done really. Again, I've been looking at some of the forecasts for oil prices. And when compared to gas prices are expected to peak in the second quarter of this year and start to fall back because of reducing demand. Oil is expected to continue to rise over the course of this year. So again, something else to think about, something else to budget for. Wish I had some better news.
Okay, brilliant. Thank you very much indeed for that. Now, I've just been told by the team that support us that you're not going to automatically get that document. What I need to do is just launch a poll. So I'll just quickly do that. If you just pop your, because I think Zoom now got so private, they don't do it. So I've got a poll running there. So can you see that? You see it, Jamie?
Yeah.
Great. So if anybody on would like to get that document, those useful links, then if you just pop in there your email address, we'll get that out to you. And I promise you, we won't be using that for marketing purposes or anything like that. We're purely going to give that to you. And the same goes for the financial wellbeing assessment. If there's anybody out there representing an employer, we use that assessment for companies to get to find out what's going on inside their workforce. And it's become very popular the last few weeks. As you can imagine, people are saying, look, you know, we don't know what's going on with our employees. We want to know where they are in their thinking and their financial stress levels. And so this is a great way of sense checking it. And it does help employers strategically pinpoint where the highest levels of stress are sitting, because it's sometimes a taboo subject and people don't want to share it. But you know, having an assessment across a workforce like that. So have a look at it. But for those of you that don't represent an employer, you're just here for your own benefit as an employee, feel free to play with that, get your recommended action plan, check your score, and then use that maybe every 6 months, see how things are going. because it's really important for overall well-being that our finances are in order. I've certainly had a lot of stress last year, and interestingly, I had my cortisol measured, I had my cholesterol measured, and they were off the scale, and that's stress related. So it wasn't financial stress, some other things in life, but certainly we, taking control of the money situation is really good for our overall well-being. So we know that half of mental health problems are triggered by financial worry. So I'm going to leave the poll running because we got, oh, blimey, there's a lot of people requesting that document. That's great. Good news. Okay, I just need to do this. I just need to screen share this final piece because it is the caveat, I think. So let me just do that, and then I'll keep the compliance department happy. Well, where we're done with it, and then what we'll do is do the questions. Right. Oh, somebody said they can't see the poll. Can you? Well, we've had 140 people can see it at the moment, and they've voted on it. So, not sure what's going on there. Don't know. Sorry about that. Right. Okay. I can't get this PowerPoint to run, and then we'll do the questions. So, where am I? Okay. Screen share. Right, if you can see that, I just have to pop that up, keep everyone happy. There you go. Right, take it down again. That sounds crazy, but that's the regulated industry we work in. The regulated industry where it's easier to get a loan than it is to invest some money. Can you believe it? Right, okay, Jamie, I'm going to put you on the spot now. So those of you that are happy, feel free to go when the half an hour's up. But those who want to stick around, we have got a lot of questions. So let's see how we get on. I'm going to open them up. There's quite a few questions in there which are a bit unrelated to the topic. So I think we'll take those off. So there's quite a few pension questions. Someone's looking to retire in a couple of years and wants some help. That's fine. We can signpost, we can sort that out. I won't mention the name because she's asked not to go public on it. Someone's got a question, a pension question. Okay, so if you haven't heard from your energy provider, should you be in touch with them? We are still pay the same monthly cost at the moment. Is that a concern? Do you know much about that one, Jamie?
Yeah, so with the energy price cap, importantly, it only affects people who are on the default rate. So if you're fixed in, that's probably the reason why you haven't been contacted by your energy provider. You're probably still in a fixed period. You might want to just check when that fixed period ends, because when it does, the price, your energy costs are obviously going to rise significantly. So that's probably the reason why. Just something else to mention on that. Again, the consensus is that there's little benefit in fixing into another rate at this point in time. Something to be aware of. Generally, the fixed rates now are higher than the sort of the default rates, so you're best off just sitting on the default rate and then waiting for gas and electricity prices to fall back down again.
Yeah, I think because we talked about smart meters and we spoke about smart thermometers, which I've taken action on since our initial conversation, Jamie. Thanks for that. There's quite a few people mentioned on here. What do they do if they're a rental property?
Well, I think that's a question for your landlord. So speak to your landlord, because I don't think if you're renting a property, the cost of installing a smart thermometer should fall down to you. When it comes to the smart meter, obviously there's no cost involved at all. So I can't see why your landlord would object to that. But yeah, it's I'd certainly, as a first port of call, speak to your landlord about that.
Brilliant. Thank you, Jamie. There's a question here, quite an interesting one. Could Jamie expand on investing our savings instead of considering a savers account? Does he mean an investment account, e.g. money box?
Yeah, that's right. So any sort of type of investment account. So just going back to the fundamentals. Obviously, if you have cash is great as what we call a contingency fund. So it's sort of rainy day money. If you have an emergency or anything like that, cash is a good place to put your money, either in a savings account, premium bonds, national insurance, that sort of thing. Generally, if you have cash available that you don't need for at least 5 years, so you can sort of tie it up if you like, then we would look at alternatives to cash. So investing the money, that would be in a portfolio of other assets. So it could be in shares, in bonds, in property, gold, commodities, a mix of assets. It will depend on how somebody feels about investing, what their appetite is for risk. There is a spectrum. So if you want to take smaller amounts of risk, then your advisor can find a portfolio that's suitable for you. But it's all to do with that investment horizon. That's the most important thing. If you've got at least 5 years, then I would encourage you to look at alternatives to cash.
Now, it does lead on to a couple of other questions, Jamie. Is people are keen to get their money growing. So there's two kind of questions here. One is where do they start? And the second one is, should I pay down some of my mortgage instead? Since my savings will go down, potentially go down in value, should I pay some of the mortgage off instead? So a couple of questions there. What are your thoughts?
Yeah, so with the mortgage one, I think it's quite a common question, isn't it? We've had this a few times before, and I don't think there's any real perfect answer to that, because it's based on what might happen in the future. Because generally at the moment, interest rates are still pretty low. If you look at the rate that you're paying on your mortgage, it's still going to be between 1.5% to 2% as a sort of a standard rate, if you like. Now, if you look at investment returns, generally over a longer period of time, on a balanced portfolio, you'd expect an investment return of about 5%. So you'd be better off investing your money, because the return is going to outweigh the cost of keeping a debt. But it's a very psychological thing for people, because many people just feel that a mortgage is a big financial commitment. It's a bit of a millstone around the neck, and they want to get rid of it. And once they've paid off the mortgage, then they can use the surplus income to save. So I don't think there's any perfect answer. It does depend on your individual situation. And sorry, what was the other question around?
Well, the other question, I can start the answer. So the question was, where do I start when it comes to investing? And what I've just done is I've just popped into the chat box a link to the our Financial Fitness Fridays channel on YouTube. And on there, you can see Jamie and other experts talking about investing, how to get started and all that sort of thing. So feel free to jump on there and watch some of those recordings. I think that would really help get people going. But on top of that, Jamie, where else should people start when it comes to investing?
Well, I think that, as you say, there's lots of resources out there. You can always speak to a financial advisor, a financial planner, as a sort of starting point. Get a sense of what they can help you out with. Any good financial coach or financial planner will talk to you about what you want your money to do for you. So, what is the purpose of saving? What are you investing money for? Is it sort of for the short term? Is it more a longer term objective, like retirement? So I think that's very important. And then they can go help you to create a financial plan, or help you to look at the various different options out there. If you feel that your situation doesn't really require that, perhaps you want to look at something in isolation, perhaps just at the moment just setting up a pension, then there's lots of low cost, I would say, providers out there. We call them robo-advisors. So a good example of one is a provider called Hatch, where they'll take you through a decision tree on their online portal, and depending on the various answers that you give around your purpose for saving, your appetite for investment, your views on investment, out will pop a recommendation and say, this is the product for you, and this is how we recommend that you invest your money. Clearly, there's going to be fees involved in that process. It's really important that you check what those fees are up front. Good providers will always be transparent about their fees. You'll be able to find it on their website. So there's two approaches there. It will just depend on how complex you feel that your situation is. But any again, good advisor like myself will always be willing to and happy to have a conversation at no cost with people, have a chat with them, and if they can't help, then point them in the right direction.
Brilliant. Somebody asked me, or a couple of people asked me, to relaunch the poll, so I've done it again. I don't know if for first one then gets deleted or not, so I'm hoping it's fine. So the other thing I'm not sure it went out. I think I might not sent it to everybody. Jamie, you said Hatch, they've rebranded now. They're now called Octopus Money Coach.
Right, okay, yeah.
Octopus Money Coach, okay? Because someone said, did you say Patch? Quite funny. I've just resent, because I didn't think it went through, the link for the financial wellbeing assessment. Not a bad place to go. It gets you pointing in the right direction, give you a benchmark to work from, and you can sense check it going forward. Okay, what other questions we got? Let's have a look at some new ones coming in. How are we doing for time? Yeah, we're all right for a minute. Okay. Jamie, how about just paying more cash into my pension pot?
Absolutely. I mean, if you can afford to save more into your pension, then clearly, the more you save, the bigger the pension pot, the better the outcome for you in retirement. It might mean that you can either retire a little bit earlier than you expected to, or you've just got more to spend and enjoy in retirement. And at the moment, financial markets are probably a little bit more volatile than normal because of concerns around inflation and Ukraine. But when you're drip feeding money in each month, volatility is your friend. You're taking advantage of those market dips. You're buying at lower prices. So it really is beneficial. We call it pound cost averaging. Again, I think we've done a session previously on this. But yeah, if you're in a good position where you can afford to save more towards your retirement, saving in your pension is one of the most tax efficient things you can do. So I'd certainly encourage you to do that.
Someone's put DCA. I think there must be someone from America on there, dollar cost averaging. I'm assuming that's what it means. Okay, any more questions? So someone's asking about Ukraine. So rather than not get into politics, but do you think this would have, how's the war in Ukraine impacted fuel bills, or would this have happened anyway, is the question?
I think it's fair to say that prior to the invasion of Ukraine, which was back in February, oil and gas prices were already on the rise. They were already pretty tight, particularly in the oil market, but certainly gas prices, I think they had increased 4 or 5 fold at that point. And that's said to be driven by the demand that has effectively built up as a result of the pandemic. So remember, many of us in the pandemic, or many people, I should say, were restricted spenders. You couldn't go out and spend the money because we were all locked down, clearly, and so the savings rate actually went up. Also, governments were quick to protect incomes, and they were announcing lots of different schemes, such as the furlough scheme, the bounce back loan scheme, all that kind of thing. So, and that's not just in the UK, but lots of governments around the world doing a similar type of thing, dropping in what's known as helicopter money. So that again has helped to fuel that demand, and really oil and gas prices are rising off the back of that. Now, there's no doubt that clearly there's repercussions. Further repercussions, if you like, on oil and gas prices as a result of the invasion of Ukraine. I mentioned there about oil is forecasted to continue to rise in the second half of this year, and one of the reasons is because companies now and providers are turning away from Russian oil. They don't want to ship Russian oil around the world anymore. They don't want to be seen to be dependent on Russian oil. And Russia's a big provider in terms of the global oil supply. It's said to provide about 11%. So, yeah, I think it's very mindful. I mean, a lot will depend in terms of the future oil and gas prices. A lot will depend on what happens in Ukraine. Obviously, we don't know at the moment, but if the situation continues to escalate, there's no doubt that will continue to put pressure on oil and gas prices.
Okay, thank you. I'm going to just satisfy the people that have got pension questions just very quickly. Someone said there's a company called Pensionbee. Are they safe to use?
To be honest, I'm not very familiar with Pensionbee, and I don't like to be seen to be making recommendations for any particular providers without having done any research myself. I know that they are a fairly big company. They're one of these sort of businesses that help people to consolidate their pensions at a lower cost, I believe. Whether that's right for somebody as an individual will depend on lots of different factors. Yeah, I'm sorry, I don't want to be seen to be evasive on it, but I can't endorse something without really knowing much about it, I'm afraid.
We've got the usual, just to finish off, we've got the usual, what about crypto,
Yes, yeah.
Got any comments on that?
Again, I think it's something we've covered before. Very interesting about crypto is it was said to be a store of value, like a digital version of gold. But actually that's proved not to be the case, because whilst gold has gone up in value over the last couple of months due to increased economic uncertainty, Bitcoin has actually fallen in value. So it's actually behaved in a way that the analysts and investors in crypto didn't expect. So I think a bit of a warning there for people. Look, it's hugely speculative. I think there's only a handful of people in the world that actually know how Bitcoin truly works. To me, it's very opaque. We don't know who owns all the cryptocurrencies. I believe that they're probably most of it's probably owned by a small number of people who can manipulate the market. But for a bit of a, if you like, a punt for 1%, 2%, 3% of your savings, why not? But I wouldn't bet your retirement on it.
Brilliant. Thank you very much indeed, Jamie. That's all we've got time for. I think just checking. There are lots of unanswered messages. What we're going to do, someone just talked about solar panel. I've actually asked for a quote. Now there's no VAT on them, just to do some maths if it works out. Good idea. Yes. So thanks for jumping on, everybody. Thanks for jumping on, Jamie. Really appreciate it. We have run out of time, but we'll, as and when we'll do more. If there's demand for this, we'll do more. If you want to, if you put your email on, we'll send you the document with all the resources on. If you want to try the financial wellbeing assessment out, please feel free. We won't be contacting you. Do not panic. This is not a marketing exercise. I just want to let you have a tool to help. This was really the lesson today, I think, has been about, look, there's no magic wands. We are where we are. I think it's engaging with the problem, getting on top of it, trying to control it and manage it and minimize some of those stresses. I think it's the key thing here. If you're an employer and you want to have a play around with that demonstration link for the financial wellbeing assessment, and you're interested in doing something for your employees, just pop me a note, because there are ways we can do that for employees, and you can actually get a corporate report on that. So quite useful if you want to sense check how people are feeling right now. So that's it. I think we've done. Thanks very much, everybody. Thanks so much, Jamie. And we'll keep you all posted as and when we do the next special edition. Watch this space. Take care. Bye for now.
Bye, everyone.